Hello, clients and friends. Welcome to our Q3 2024 market update. I have with me, as always, Charles Blankley, our Chief Investment Officer at Kimmer Asset Management. And we're going to go through a few slides in 10 or 15 minutes to give you a pulse on the market. Charles, let me turn it over to you.
Great. Thanks, Tim. Hello, everyone. I'll keep this relatively short. But as always, if you have questions, comments, reach out to Tim and we can always set up a separate discussion or call. So just third quarter, a quick recap. It was a good quarter for stocks, as you can see. All the main equity indexes were up mid to high single digits. And for the first time in a while, actually, the international markets and the small cap indexes outperformed the S&P 500, which was nice to see. So the big
Charles,
thing,
Charles, let me just jump in right there. The U.S. has outperformed for a very long period of time now. A quarter doesn't, just maybe noise. Is there something going on there? Is it U.S. currency? Are economies doing better? Is it valuation? What's driving the ex-U.S.?
yeah, part of the move, or a big part of the move in the quarter of international over the US was just valuation, that international stocks had got very, very cheap. And so when they bounced more than the US equity index. In an emerging too, you had Chinese stimulus. So the Chinese authorities came out, cut rates, took steps to try and support the market. So that drove the emerging market return for the quarter. Now, whether it's sustainable, we'll have to see. But definitely there was the theme during the quarter of lower interest rates. You can see the Fed cut rates, also the Bank of England, the European Central Bank, Bank of Canada. So we're in the middle of this global easing cycle in monetary policy that does look like it's sustainable. It's likely to run through the first or second quarter of next year. Just to put the quarter in perspective, this shows 2024 through the end of the third quarter performance relative to similar periods going back to 96. So this is the second best year since 97. So, it's probably worth just appreciating how good this year has been in the equity markets. And as I say, it's unusual that we're seeing coordinated interest rate cuts. And so in September, so last month, there were 21 interest rate cuts around the world. And that's a lot. That's more than we've seen really outside of the financial crisis and during COVID. So inflation has been tamed. Rates have gone up too much and there's room to cut. And that fed through into bond and stock returns. And bonds are having an okay year. You can see that the 2-year Treasury bond has gained 4% this year. 5%, the 5-year bond is also up 4%, and the 10-year and the 30-year have lagged. And the 30-year's return has actually been pretty anemic. So we've been harping on this for a while, that in your bond portfolio, it pays to stay short maturity. And that's working so far this year, and it's working in October through today as well.
Charles, just a question on the numbers. Those returns, those are total returns, so a combination of appreciation or depreciation plus the yield. Is that fair?
That's exactly right.
Right. So it would look like, most of this is probably yield. We've not had much appreciation or depreciation.
That's correct. That's absolutely right. Yep. It's virtually all the return has come through the yield component.
Got it.
Exactly. So let's talk about the economic outlook. I think the Economist cover that was out on Friday sort of summarizes it, that there's been a lot of discussion about recession risks in the United States, discussion about will we have a soft landing, which people define in different ways. But I think what we're probably looking at is there's no landing. Growth has been humming along in the US at a decent clip. And, there was a lot of talk in August and September that unemployment was increasing, job growth was slowing, but on the September data, we saw a jump higher in job growth, indicating that things are fine. The economy isn't slowing materially. If anything, it might be picking up in the fourth quarter of this year. I think the bearish argument on the economy, and if you read, any of the popular media, there's always a recession around the corner, and the bearish argument hinges on this idea that the unemployment rate has increased by roughly half a point off the low. And so this is the so-called sham recession indicator, that historically, whenever unemployment increases by half a point or more off the low, typically either we're in or we're on the cusp of a recession. And that's the case in September. We were up half a point from the low. But none of this stuff is determinate, automatically means we have a recession. And I think what's different this time, famous last words, is immigration is such a big component of the job market today, that's driving the unemployment higher, just because the job pool is increasing much more rapidly than it has in the past. So could we see a recession in the next 12 months? It's certainly possible. I'd say it's the low odds bet at the moment, less than 1 in 3. The consumer spending is solid, corporate profitability, corporate spending is robust, and critically, fiscal spending is also humming along at a pretty good clip. But I don't think that precludes the Fed continuing to cut interest rates. So when the Fed looks at the economy, they're using a model that's captured in this chart. So this is the real Fed funds rate. So it's the Fed funds minus inflation. And so when the number is high, it means real interest rates are high. And when the number is negative, obviously real interest rates would be negative. So the Fed's model is telling them real interest rates are historically pretty high, and that they have room to cut rates without triggering a resurgence of an inflation. Now, they may be wrong, and we'll find out that the cuts at some point in 25 do lead to inflation. But for the time being, the Fed's model is leading them probably to another quarter point cut this year, and then probably a couple of quarter point cuts in the first quarter of next year.
Charles, to understand the numbers, that zero line, that's where there's effectively no difference between the inflation rate and the Fed funds rate. So it's completely neutral. And that's basically their target, one would think.
It's plus or minus something around that zero line. That's exactly right. And that's the rate at which they think the Fed funds is neither stimulative nor contractionary.
So if inflation is 3.5%, we should be looking for roughly a 3.5%. I mean, making those numbers up, but in that range, a 3.5 Fed funds rate. So we still have room to fall.
That's exactly right.
Yep, got it.
Yep. Okay. I think the other risk that we've all been talking about that we're very tuned into is the risk of an oil shock, given what's happening in the Middle East. And I have no insight, obviously, into how things are going to play out. But I would indicate that the economic situation as it relates to oil is very different from what it was in the 70s. And so this chart is showing you net oil imports or exports in the United States going back to 1970. And so you can see during the decade of the 70s, the US was a net importer. And a lot of that oil came from the Middle East, Saudi Arabia specifically. And what's happened really ever since 2006, 2007 is domestic production has grown dramatically in the shale fields. And so today we're a net oil exporter. And so we're now in surplus in the sense we produce more oil than we consume. And that's true with particularly with natural gas, where we're a net exporter of liquefied natural gas, with a lot of it going to Europe at the moment. So this doesn't preclude an energy shock or a spike in oil prices if Israel attacks Iran, for example. But I think the economic sensitivity of the US to rising oil prices is much different from what it was back in the 70s. I think the other piece to remember too is the US gets no oil from Iran. And so if you're thinking about the geopolitical risk of who has a problem if Iranian production goes to zero, and it's really China has the significant exposure to a cutoff in Iranian oil supplies. China basically consumes the vast majority of all of Iran's production. And so if the Straits of Hormuz are closed for whatever reason, China will be the one that has the supply problem. The US is relatively insulated from what happens with Iranian production. So we've had a lot of questions, when Tim and I have talked over the last few weeks of, well, if the Fed's cutting rates, surely we should be buying long-term bonds. And we've been making the case, and Tim's been pretty vocal on this as well, that just because the Fed is lowering short-term rates, it doesn't mean long-term rates have to go down. And so this is an example I pulled a few days ago. It's the 30-year mortgage rate, for example. And you can see the day where the Fed cut interest rates was basically the low in 30-year mortgages. And that since then, they've rallied almost 70 basis points, 0.7% over that time period. And I think we probably have more of this to come. If the Fed is lowering rates and the economy remains resilient as we think, I think there's room for long-term rates to drift higher. And so from a bond strategy perspective, owning 2-year treasuries and shorter maturity than the 2-year is still the place to be. Now, granted, yields are going to fall, but you have very little price exposure if long-term rates were to go up like they have over the last few weeks.
Good. Charles, let me just lay on that a translation commentary for those who are less familiar with bond math, right? So bond prices move inversely to yield, okay? So when yields go up, bond prices fall. So on the 30-year, if you're very long dated, right? If mortgage rates and interest rates on the long end of the curve go up, you're going to lose money or poised to lose money. As Charles is saying that if our bond portfolios are concentrated in more short-term areas of the market, much of your return comes from earning that yield as opposed to being exposed to what happens if interest rate changes. A second commentary here, Charles, directly relates to the fact that this is a mortgage chart. I've had clients purchasing houses under the presumption, or not under the presumption, but presuming that mortgage rates are going to come down. That's absolutely not the case. They don't move in tandem. They're affected by really different dynamics. The Federal Reserve controls overnight lending rates. That's it. Long-term components of the fixed income market, of which the mortgage market is an enormous element, are impacted by fundamental supply and demand moves, right? And so including the outlook long-term for government deficits, potential inflation, et cetera, et cetera, et cetera. So it is hyper simplistic. It's overly simplistic, and it's simply wrong to say, if the Fed's cutting, it's going to get cheaper to buy a house. I don't know that, and that certainly has not proven the case in the last month or so.
It's a good observation. Spot on. Equity market outlook. And so this chart is stating the obvious, but sometimes stating the obvious, I think, is worthwhile. And so the blue line basically shows you how the stock market performs either side of the first Fed rate cut. And so that vertical dotted line from 0 is the day of the first rate cut, going back and looking at previous cycles. So in this case, Goldman Sachs went back over the last 40 years and looked at previous cycles when the Fed cut. The blue line is telling you, typically after the first rate cut, if the economy avoids a recession, stocks tend to do well. The gray line is when the economy falls into a recession. And so, again, stating the obvious, after the first rate cut, if the economy falls into a recession, stocks go down. And so, we get the question, what are stocks going to do now the Fed's cutting rates? And it really comes down to, where's the economy going? If you think we're falling into a recession, stocks will go down, earnings will contract, equities will follow. But if we avoid the recession, which I think we will, at least over the next 12 months, I think there's room here for stocks to do fine. We should continue to see earnings growth. Lower interest rates should be a tailwind for stocks as well. And so I would argue we're more likely to follow the blue line than we are the gray line over the next 6, 9, 12 months. I think the big issue going forward is, where's the earnings growth going to be? And so this is showing you quarter by quarter earnings growth for the Magnificent Seven. So that's the blue bar, and then the other 493 stocks in the S&P 500. And so the square is highlighting that really over the last few quarters, we've only seen earnings growth in the Magnificent Seven. And in essence, that's why the Mag 7 has outperformed, has become such a large component to the S&P 500. looking forward, estimates are that the rest of the market, the 493 stocks, the rest of them in the S&P 500, we're going to see earnings growth there for the first time in a while. And so I think this is why the market is starting to broaden out. It isn't just the S&P 500 that's doing well. You're seeing mid and small and stocks outside the Magnificent Seven that are starting to perform, in some cases, outperform the Magnificent Seven. So I think the theme for the next few quarters is likely to be broader performance. It isn't just NVIDIA and Tesla and Google as the only stocks doing well. I think there's going to be more pockets of opportunity in the equity market. And I think the key piece is the 493 stocks are much cheaper than the Magnificent Seven today. So not only do you have an earnings story, hopefully there's a valuation tailwind as those multiples normalize over the next few quarters.
Mm-hmm. Charles, a commentary on this, on that circle, the oval on the right, that's the core really of wealth creation for my clients, right? If you say, why do stocks go up? Well, stocks are priced on a number of metrics, but a core is a multiple of earnings, right? And so let's just say that's a 20x in earnings. And the PE ratio, which is called, can change over time. But the denominator of that element is earnings. And if earnings grow 6% a year, all things being equal, you should generate a 6% return on your stocks. I'm making that number up. But if you really boil down wealth creation and your allocation to equities broadly, into something like an index like this is, for the S&P 500, and you see lockstep earnings growth, all things equal, that means the value of your stocks will go up over time.
And it's no different than if you and I were buying a laundromat, is it, right? If you see you're buying a laundromat that can grow its earnings at 6-7% a year, year after year, those earnings are going to double over 9, 10, 11 years. And so that's all we're doing with an index fund is we're buying businesses.
Right.
And we're buying a cash flow stream. Yeah, that's a great observation. And then I think the final piece I just want to point out is it's stunning how much money has flowed into money funds over the last few years, but even over the last 12 months. And so this is the amount of money sitting in money funds, surpassed 6 trillion. It's the highest ever. And so I'm not going to argue that all this money is going to flow into bonds or stocks as rates come down. But I would think that a part of this pile is likely to become motivated to find another home as the yield on money funds declines, as the Fed's cutting rates. And it isn't, money flows into stocks because for every buyer, there's a seller. But I would argue that some of the people sitting in money funds are going to be more motivated to buy risk assets, bonds and equities over the next 12 months as money fund yields fall. So that's basically it. I think we're in the middle of a global easing cycle. How long it goes is hard to say, but I think the Fed's likely to cut rates through at least the first quarter of next year. We could see the European Central Bank, the Bank of England, Bank of Canada cut for longer. And because of that, I think there's a good chance growth holds up. We avoid a recession in the US in particular. We did a separate WebEx on the outcome of the election where we got into a lot of detail, but all I'd say is I think we'll be surprised how little of an impact the election has on the real economy and the markets when all is said and done. I think that in the Middle East, it adds volatility and uncertainty, but I think when the Fed's in a rate cutting cycle, that should help stabilize the real economy. I think bonds probably, they probably priced in too much easing. I think there's room for long-term rates to go up, so we would stay short maturity still. But I think equities can do fine. So I think stocks beat bonds over the next few quarters because as Tim pointed out, right, we're seeing broader earnings growth and that should support equity prices. Tim, over to you.
Great. Charles, as always, thank you for being so succinct. We will talk again next quarter, and my clients and friends, call me if you have any questions.